By the end of this video, you will understand exactly how a single software disagreement managed to split the world's most famous cryptocurrency in two, and you will know if the fork actually succeeded in its original mission. There is a hidden story behind the collapse of Bitcoin Cash, and the final outcome is something that most crypto enthusiasts still refuse to acknowledge. Grab a glass of water, get comfortable, and let's look at the history of the great Bitcoin schism. To understand the fork, you have to go back to the summer of 2017. Bitcoin was having an identity crisis. It was born as a peer to peer electronic cash system meant to be used for buying coffee or paying for services. But as the price surged toward $20,000, the network became clogged. Every transaction took hours, sometimes days, and the fees became astronomical. If you wanted to send $5 worth of Bitcoin to a friend, you might end up paying $20 just to process the movement. It wasn't working as cash anymore. It was acting like a digital gold vault. This created two camps. On one side, you had the people who believed Bitcoin should remain a store of value, like gold, prioritizing security over speed. On the other side, you had the originalists, the people who wanted to keep the cash in Bitcoin. They argued that if the blocks were simply made larger, they could fit more transactions at a lower cost. The clash was inevitable. On August 1st, 2017, a group of miners and developers pushed the button to diverge from the main chain. They created a new currency, Bitcoin Cash. Everyone who held Bitcoin at that moment suddenly received an equal amount of the new token. It felt like free money, but it was actually a high stakes bet on the future of decentralized finance. This leads us to our first point, the easy win. If you were holding Bitcoin on that day, you effectively doubled your asset count overnight. People who had spent years accumulating fractions of a Bitcoin suddenly found their portfolios expanded by the exact same amount of Bitcoin Cash. It was the largest wealth distribution in crypto history at the time. For the average user, the fork was a massive win, even if you didn't care about the underlying technology. You had an extra asset that was trading for hundreds of dollars per coin. But there is a catch that people often overlook. The market split the value. Because the original Bitcoin was now slightly less efficient in the eyes of the proponents of the new coin, some value leaked out of the main chain. Or did it? Actually, in the weeks following the fork, the price of the original Bitcoin continued to climb toward record highs, while Bitcoin Cash struggled to find its identity. It was a classic case of market perception versus technical utility. Now, here is where it gets interesting. Let's talk about the level up. Why the scaling argument wasn't just a technical disagreement, but a social one. The Bitcoin Cash team argued that blocks should be 8 megabytes instead of 1. That sounds like a simple upgrade, but it had massive consequences for decentralization. If you make the blocks larger, you need more storage and more bandwidth to run a node. If you need massive server hardware to run a node, only a few companies or wealthy data centers can afford to do it. The critics of the fork pointed out that this effectively centralizes the system. Instead of having 10,000 small nodes around the world, you end up with 100 big ones controlled by whoever pays the electricity bill. That is the opposite of the philosophy that Satoshi Nakamoto originally laid out in his white paper. My friend Marcus, who had been mining since 2012, watched this play out in real time. He sold all his Bitcoin Cash the second it hit the exchanges. He told me that for him, it wasn't about the price, but about the trust in the underlying code. He saw the fork as a move toward corporate control, and he didn't want any part of it. Are you finding this perspective helpful? If you are, consider hitting subscribe. It really helps me keep digging into these forgotten tech histories. And stick around because the final point is the one nobody talks about, and it completely changed how we look at forks today. Okay, so that's the first two layers. Now, let's get into the one I've been saving for you. This is the ultimate lesson of the Bitcoin Cash experiment. If you look at the price charts today, Bitcoin Cash is a shadow of its original self compared to the main Bitcoin network. Why did it fail to overtake the original? It's because of something called network effects. You see, the value of a currency isn't just about speed or block size. It is about the number of people who accept it, the number of developers building on it, and the amount of capital secured by its hash rate. When you fork a blockchain, you are essentially trying to split the community in half, but people don't move that easily. The entire ecosystem of exchanges, payment processors, and wallet providers stayed with the original Bitcoin because that was where the users were. By the time the dust settled in 2018, the reality was stark. Bitcoin Cash was being treated as a speculative side project rather than a global currency. Then, something even more surprising happened. A second fork occurred, creating Bitcoin Satoshi's vision, or BSV. This is the part that proves my point. The more you fork, the more you dilute the value and the trust of the entire project. It becomes a game of musical chairs where everyone is looking for an exit. Think about that for a second. If money is about trust, then creating 3 or 4 competing versions of the real Bitcoin destroys the very thing you are trying to build. Bitcoin won not because it was the fastest, but because it became the standard. The fork taught us that code is easy to copy, but community is impossible to replicate. You can clone the software of a banking system, but you cannot clone the trust of millions of people who have already agreed that one specific ledger is the truth. Once you see it this way, you can't unsee it. Every time someone proposes a better version of a successful protocol, they are usually missing the point that the network effect is the most expensive and rare commodity in existence. So, where does that leave us? Bitcoin Cash still exists and it still functions, but it serves as a historical reminder that you cannot force a protocol to become currency if the world has already decided to use something else. It was a multi-billion-dollar experiment that proved the importance of stability over speed. If you got value from this breakdown, share it with someone who is still wondering why there are so many different versions of crypto out there. And make sure to subscribe so you don't miss our next dive into the secret histories of the tech world. I am planning to cover why the original internet protocols are still running the show even decades later. You won't want to miss that one. Thanks for spending your time with me today. It's been a pleasure exploring this history with you. See you in the next one.